Looking at a stock that plummeted from a 52-week high of $193 all the way down to $19, but is suddenly like surging again on massive volume. I mean, are we looking at a classic falling trend, flashing sell signals, or a radically undervalued strong buy?
Yeah, it is the ultimate financial Woshock test of the moment, really. You glance at that chart and you either see a generational wealth building opportunity or, a giant glowing red flag.
Right.
There is almost no in between here.
And navigating that exact divide is our mission for today's deep dive. We are tearing into the April 21, 2026 data on Oklo Inc. For those of you pulling this up on your terminals, the ticker is OKLO.
Yep, okay, low.
We're looking at a highly volatile, completely pre-revenue advanced nuclear fission company today. We really want to peel back the layers of this hype cycle to see what is genuinely operating beneath the hood.
Which is a lot of complexity, to be honest.
Exactly. But before we get lost in the weeds of nuclear regulation and cash burn, a quick favor to ask you. Tracking these wild market narratives takes a community, so please like the video and subscribe to our YouTube channel. And it is absolutely compulsory that you leave your comments and feedback below. We really want to know how you're playing this volatility.
The volatility is the defining characteristic here.
Sure.
Just to set our baseline, as of today, Oklo is trading at $68.13.
Okay.
Which is up almost 2% for the session. But, a single daily blip is virtually meaningless for a stock like this. The entire valuation of this company is essentially a high-stakes tug of war.
How so?
Well, pulling hard on one side, you have the almost terrifying future energy demands of artificial intelligence data centers. And then pulling in the opposite direction, you have the notoriously slow, methodical, and unforgiving grind of nuclear regulatory progress.
Man, that is a heavy dynamic. So before we can even begin to understand the why behind this stock's wild swings, we have to map out the how. Like the sheer mechanics of its price action tell a fascinating story.
Oh, absolutely. The chart is wild.
Right, because Oklo is sitting at $68.13, but contrast that with its 52-week range. We're talking about a canyon here. It hit a brutal low of $19.89, falling from a dizzying nosebleed high of $193.84.
It's a massive drop.
And right now, the 10-day average volume is hovering around 12.5 million shares. That tells me this isn't just algorithmic noise. There is heavy convicted retail and institutional interest fighting over this current price level.
Yeah, the conflict in the trend directions is exactly what makes the technical setup so tense right now.
Yeah.
The short-term trend is undeniably positive. The stock is up over 26% in just the last month.
Wow, 26%.
Right, that is aggressive upward momentum. But if you zoom out, the long-term trend remains deeply compromised because the price is tracked so far below those late 2025 highs.
So the people who bought at the top are just sweating.
Exactly. When you look at the technical levels, the market psychology becomes very transparent. You have solid support, basically the floor where buyers consistently decide the stock is too cheap to pass up, setting firmly at $45.38.
Okay, $45.38 is the floor.
But the ceiling is a brick wall. Resistance is incredibly heavy, right around $73 to $74.21.
So every time it approaches that $74 mark, an invisible hand just swats it back down.
Basically, yeah.
It sounds like a rubber band that got stretched way too far to $193, snapped back violently to $19, and is now just vibrating in the 60 days trying to find its true shape. People are using that $74 level as an escape hatch, right?
Precisely. And if we look at the momentum indicators, the relative strength index is currently sitting at 64.7.
Which means what exactly?
Well, rather than just viewing that as a static number, think of it as a pressure gauge. It's leaning toward slightly overbought, meaning buyer enthusiasm is running hot, but it hasn't quite crossed into that extreme 70-plus territory where the market usually forcefully corrects itself.
Got it. What about the MACD?
Meanwhile, the MACD is at 2.64, flashing a bullish signal that upward momentum is still accelerating. But the real story is in the moving averages.
Okay, lay it on me.
The 50-day simple moving average is $59.61. The current price is broken above that, which is excellent for short-term sentiment. However, the 200-day moving average is looming way overhead at $85.65.
That's a huge gap.
It is. Because the current price is still stuck below that 200-day line, it indicates significant long-term overhead weakness.
Okay, I am going to stop you right there and just push back on this entire framework for a second.
Sure, go ahead.
Honestly, I find applying technical analysis to a company like Oklo highly questionable. We're talking about moving averages and MACD crossovers for a startup that doesn't actually sell product yet.
I get where you're coming from.
Right. Aren't technicals like moving averages kind of useless when a company's entire future rests on binary news catalysts, like a regulatory approval rather than, current quarterly sales growth?
Yeah.
Charting this feels a bit like reading tea leaves.
I fundamentally disagree with that premise, though it is a critique you hear often from traditional fundamental analysts. When you apply technicals to a legacy company like Ford or Coca-Cola, yes, you are analyzing the price relative to their earnings.
Yeah, actual cash flows.
But here's the critical difference. When a company has zero revenue and zero earnings to anchor its valuation, human psychology and sentiment are the literal only things driving the price.
Huh, okay.
Those technical levels aren't arbitrary math. That $74 resistance level exists because a massive cohort of investors who bought into the hype at $100 or $150 are sitting on painful losses.
Oh, I see.
The moment the price recovers enough for them to minimize the bleeding, they sell. The technicals map the exact coordinates of investor regret and investor greed.
That reframing actually makes perfect sense. It's not charting the cash register. It's charting the behavioral economics of the shareholders,
Exactly.
which is the perfect bridge into the reality of their actual business. If the technicals map the sentiment, what do the hard numbers on the balance sheet tell us? Because the financial reality here is stark, to put it mildly.
Stark is an understatement. Looking at the fiscal year 2025 income statement, revenue is exactly $0.
Yeah.
Zero. Oklo is entirely a development stage entity. And while the revenue is non-existent, the expenses are staggering. The operating loss for 2025 was $139.3 million,
Wow.
with the net loss landing at $110.2 million.
Over $100 million out the door with literally nothing coming in. But they do have a massive liquidity buffer to absorb that, right? And they aren't broke.
No, they definitely aren't broke. The balance sheet shows approximately $1.4 billion in cash and marketable securities.
Okay, so that's a cushion.
A huge cushion.
Right.
Depending on how aggressively you calculate their broader liquidity capabilities and credit facilities, some estimates project they could access up to $2.6 billion.
That's a lot of runway.
So the runway theoretically is exceptionally long. In 2025, they burned $82.2 million purely in day-to-day operating activities. But the figure that recently made institutional investors literally gasp is their 2026 guidance.
Wait, what is it?
Management is projecting $350 million to $450 million in capital expenditures for this year alone.
Okay, I want you, the listener, to conceptualize that jump in spending. Imagine you're running a household where you have a huge savings account, but zero income.
Right.
And you just decided to quadruple your spending this year. Or, imagine running a biotech company. For years, you've been running computer simulations and doing cheap, early-stage lab work.
Your cash burn is manageable.
Exactly.
Yeah.
It's manageable. But suddenly, you get the green light for a massive Phase 3 human clinical trial across 40 hospitals. Your costs don't just inch up, they multiply overnight. That feels like what is happening here. They aren't just sketching reactors on iPads anymore.
That is an excellent equivalent. Designing a next-generation nuclear reactor in a CAD program is relatively cheap. But that $450 million CapEx projection is the sound of a company attempting to transition from software to heavy industry.
And heavy industry is not cheap.
Not at all. Bending specialized nuclear-grade metal, securing highly regulated supply chains for enriched uranium, prepping physical sites, and building the infrastructure for an advanced fission reactor is phenomenally expensive.
Yeah, I can only imagine.
The cost of raw materials and specialized engineering talent in the nuclear sector is astronomically high. That surge in spending means they are forcing this project into the physical world. So they are sitting on a dragon's hoard of cash, but the dragon is burning it from the inside.
But that massive capital outlay brings up a glaring question of conviction. If they are burning through almost $500 million this year to manifest this technology, you would expect the people closest to the project to be holding on to every single share they own.
You would think so, yes.
But when we follow the money, the actions of the insiders paint a very, very complicated picture. What are the people closest to the money actually doing with their shares?
Well, the optics here are incredibly messy. In late 2025 and early 2026, we saw massive insider dumping.
Define massive.
CEO Jacob DeWitt and CFO Craig Bielmeier sold roughly $136 million worth of stock.
$136 million.
Yeah. Now, from a regulatory standpoint, it is crucial to note that this was largely executed under pre-planned 10b5-1 plans.
Which are the automated schedules, right?
Exactly. Those are automated, scheduled selling programs that executives set up months in advance to legally protect themselves from accusations of insider trading. It takes the emotional decision-making out of the sale.
Sure.
However, even knowing that, the visual of leadership unloading 9 figures of stock is jarring to the market. Furthermore, if you look for insider buying on the open market, it is practically non-existent.
So no one is buying in.
The only buying activity on the ledger is mostly just the standard conversion of derivative securities. You do not see executives dipping into their own bank accounts to buy Oklo shares at $68.
Okay, let's unpack this. I have to play the cynic here. The 10b5-1 defense is valid legally, but it doesn't excuse the underlying intent.
That's fair.
You still have to sit down with your broker and actively choose to schedule the sale of $136 million worth of stock. The executives are cashing out 9 figures of stock while simultaneously telling investors they need to burn almost $500 million this year to build the future.
It's a tough pill to swallow.
If you truly, in your bones, believe Oklo is going to be the monopoly power provider for the global AI revolution in the 2030s, why take so much off the table now?
Yeah.
Why are you cashing out generational wealth in 2026?
It really highlights the psychological paradox of the startup founder. On a human wealth management level, if 99% of your net worth is tied up in a highly volatile pre-revenue company that faces immense regulatory hurdles, diversifying is simply basic financial prudence.
Yeah, don't put all your eggs in a radioactive basket.
Exactly. You take enough off the table to ensure your family's future regardless of what the government does, but your critique is entirely valid from a signaling perspective.
It just looks bad.
It really does. For a retail investor being asked to hold through heavy volatility and trust the 2028 deployment timeline, seeing the architects of the company remove 9 figures of risk from their own plates creates a severe crisis of confidence.
And the broader market seems just as conflicted as the executives. The Wall Street analyst ratings on this stock are absolutely scattered.
Scattered almost doesn't cover it. The consensus rating is technically a moderate buy.
Which sounds nice and safe.
Right, but you have to look at the underlying spread of the price targets to understand the institutional confusion. The average target sits at $84.30, which implies roughly a 31% upside from the current price.
Okay, that's not bad.
But the high target is a wildly bullish $168, and the floor-scraping low target is a brutal $14.
Oh, wow. A spread from $14 to $168 isn't a financial forecast. That is a binary bet on survival. They are basically saying it either becomes the most important energy company on Earth or it goes effectively bankrupt.
You're hitting on the core tension there. Wall Street is pricing in two completely different realities. The analysts setting the $168 target are looking at the upside of successfully deploying commercial reactors.
And the $40 guys?
The analysts setting the $14 target are modeling out a scenario where regulatory delays drag on for years, the $1.4 billion capital pile burns out, and the company has to aggressively dilute the stock by issuing millions of new shares just to keep the lights on.
Which would crush the value of the existing shares.
Exactly. And we have also seen very notable negative signals recently from major players. Goldman Sachs and UBS slashed their targets down to the $60 to $65 range.
I downgrade.
They specifically pointed to that soaring $450 million capital expenditure guidance as the primary reason. The cash burn is making the heavyweights nervous.
So we have wild technical swings, a massive cash buffer being burned at an accelerating rate, executives taking chips off the table, and Wall Street entirely divided.
It's a perfect storm.
This brings us to the ultimate debate of this deep dive. Is this a radically undervalued artificial intelligence play? Or is it a classic value trap waiting to spring on unsuspecting retail traders?
Let's build the ultimate bull case first.
Yeah, what does the best case recovery scenario actually look like here?
The bull case is entirely predicated on the realization that artificial intelligence data centers are essentially energy black holes. They do not just need occasional power, they require massive, uninterrupted, 247 baseload power to maintain what the industry calls 5 nines.
5 nines.
Yeah, 99.999% uptime. Wind and solar are simply too intermittent to provide that reliable baseload without battery technology that doesn't currently exist at scale.
And natural gas.
Natural gas can provide the reliability, but big tech companies have strict carbon neutral mandates. Advanced nuclear fission is the only silver bullet that provides zero carbon, always on power.
And Oklo is positioning themselves as the provider.
Right. Oklo already has gigawatt-scale power agreements in place with heavyweights like Meta and Equinix.
And to give you, the listener, a sense of scale, A gigawatt is roughly the amount of energy required to power a mid-sized American city. Meta isn't asking for a backup generator, they are asking for a utility-scale infrastructure just for their AI processing.
Exactly the right context. The demand is structurally guaranteed if Oklo can deliver the electrons. They have the $1.4 billion liquidity to theoretically survive until their targeted 2028 timeline for their first reactor deployment.
That's a strong setup.
Additionally, there are major macroeconomic tailwinds at play right now. The current White House administration has shown explicit policy support for advancing space-based nuclear power and small modular reactors.
Oh, that's interesting.
Yeah, the administration has stated that revitalizing the domestic nuclear supply chain is a strategic national security priority. That creates a highly favorable environment for companies trying to push the boundaries of fission technology. Just reporting that as a policy fact, moving the market, of course.
The bull narrative is incredibly seductive. AI needs infinite power. The tech giants are already signing contracts. The government wants domestic nuclear dominance. And Oklo has $1 billion in the bank to get to opening day.
It sounds great on paper.
But let's flip the coin. The bear case here has teeth. What is the worst case continuation lower?
The bear case is rooted in the brutal realities of heavy industry and bureaucracy. First, they have 0 operating commercial projects. A signed agreement with Meta is just a piece of paper until a reactor is actually splitting atoms and pushing electricity to the grid.
Right. Promises don't power servers.
Second, as we discussed, the surging cash burn significantly elevates the risk of future share dilution. Retail traders are notoriously vulnerable to this. They see a headline that says, Meta partners with nuclear AI stock, they buy in on the hype, and they completely ignore the massive downside volatility.
They ignore the fact that the company might have to dilute their shares by 50% 3 years from now just to finish construction.
Precisely. But the financial risks pale in comparison to the regulatory risks.
Right. The biggest dark cloud over this entire operation is the Nuclear Regulatory Commission, the NRC.
The NRC is the ultimate bottleneck. Oklo is relying on what the industry categorizes as FOAK designs first of a kind. This is a crucial concept to understand.
Okay, break that down for us.
Historically, the entire framework of the NRC is built around regulating massive traditional light water reactors. Those are the giant cooling towers you picture when you think of nuclear power.
Like The Simpsons.
Yeah, exactly like The Simpsons. Their safety protocols, their engineering standards, their thousands of pages of regulations are all written in the language of pressurized water systems.
So when Oklo shows up with a blueprint for a microreactor that uses different coolants or liquid metals or entirely novel safety mechanisms, they aren't just asking for approval.
No, they aren't.
They're asking the NRC to learn a completely new language of physics.
That is the exact friction point. Getting a cautious, slow-moving federal agency to approve a completely novel, first-of-a-kind advanced fission design is a monumental task. The regulatory mismatch is staggering.
I bet.
The uncertainty around how long the NRC will take to validate these new designs is the single greatest risk to Oklo's 2028 timeline.
It fundamentally boils down to a clash of cultures. It doesn't matter if Meta wants a gigawatt of power tomorrow if the NRC spends the next 5 years staring at a blueprint with a red pen.
Exactly.
You have the move fast and break things mentality of Silicon Valley trying to build hardware in an industry where breaking things means a literal nuclear disaster.
The technology might be moving at the speed of venture capital, but the regulation moves at the speed of Washington.
That is a brutal reality check. So synthesizing all of this data for the listener, what is the realistic timeline outlook here? How should someone conceptually frame the short-term versus the long-term reality of this stock?
Well, in the short term, brace for severe volatility. Based on the technical resistance levels we outlined, the stock is going to struggle to break decisively past that $74 ceiling without a highly specific, undeniable catalyst.
Like what?
The market needs a tangible milestone, like a definitive regulatory green light from the NRC or a major physical construction update. Without that, it will likely bounce erratically between the $45 support and $74 resistance levels, entirely driven by news cycles and retail sentiment.
And the long term?
Long term, you must view this as a 100% speculative play. Its success is entirely dependent on surviving both the financial cash burn and the regulatory gauntlet until that 2028 target for an operational reactor.
It is the ultimate high-wire act in the energy sector. And, of course, we have to drop our standard reminder. Here you are just listening to two humans debating the data. Absolutely none of this is financial advice.
No, definitely not.
We are simply unpacking the puzzle pieces so you can see the whole picture before you make your own decisions.
And it truly is one of the most complex puzzles in the market right now. You are watching the intersection of next-generation artificial intelligence and next-generation nuclear physics, all being mediated by an incredibly strict legacy regulatory body.
It's fascinating.
The outcome will likely define the energy sector for the next 2 decades.
Which leaves me with one final lingering thought for you to ponder before we wrap up today's deep dive.
Yeah.
We have spent a lot of time talking about that $1.4 billion liquidity buffer.
We have.
We intuitively look at a massive pile of cash as a safety net, assuming it guarantees them a runway to 2028. But what if the ultimate roadblock isn't a matter of time, but a hard no?
That's the billion-dollar question.
If their first-of-a-kind reactor design gets outright rejected by the NRC on its first pass, and they are forced to go back to the foundational drawing board for years, does that cash pile suddenly stop being a runway to the future and instead become a very expensive, slow-burning tombstone? Think about it.